My topic is psychological pricing in detail explain, and let's go to the topic and let's go to the start. Psychological pricing is a pricing strategy that uses psychological tactics to influence consumer behavior and perception of the product's value. It involves setting prices that don't necessarily reflect the actual cost of production, but rather take into account the customer's emotional response to the price. Odd prices, prices ending in 9, 99 or 95, are used to create the illusion of a bargain and to make the price appear lower than it actually is. Anchoring, using a high-priced item next to a lower-priced item can make the lower-priced item appear more reasonable. Bundle pricing, offering a package deal or a discounted rate for buying in bulk can make the price seem more affordable and increase the perceived value of the package. Prestige pricing, pricing a product higher than the competition to create a perception of luxury, quality or exclusivity. Price skimming, setting an initial high price for a new product, then gradually lowering it as demand becomes less exclusive. Psychological pricing is a powerful and effective tool that can be used to influence consumer behavior and increase sales, but it must be used carefully to avoid any legal or ethical issues. It is important to be transparent and honest with customers about the actual price of the product and to avoid deceptive pricing practices that could damage the brand's reputation. Additionally, it is important to consider the target audience and their values and beliefs when using psychological pricing strategies. By understanding the psychology behind consumer behavior and how to influence it with pricing, businesses can increase their sales and revenue while also building strong relationships with their customers. Psychological pricing is the practice of setting prices slightly lower than a whole number. This practice is based on the belief that customers do not round up these prices, and so will treat them as lower prices than they really are. Customers tend to process a price from the leftmost digit to the right, and so will tend to ignore the last few digits of a price. This effect appears to be accentuated when the fractional portion of a price is printed in smaller font than the rest of a price. An example of psychological pricing is setting the price of an automobile at $29,999, rather than $30,000. This type of pricing is extremely common for consumer goods. A variation on the concept is to set prices higher, in the belief that customers will attach more importance to a product if the price is set at a premium level. Psychological pricing is a pricing strategy that utilizes the power of psychology or the subconscious to influence customers to spend more. This is usually a combined effort across different business functions, sales, marketing, and customer success, to leverage market trends to create irresistible offers for customers. Psychological pricing can also be described as setting prices lower than a whole number. For example, $3.99 is perceived as cheaper than $4. The idea is that customers will perceive the slightly lower price as a deal and be motivated to make the purchase. Discounting is another psychological pricing tactic that retailers can use to frame the sale of their products. Psychological pricing is a pricing strategy that impacts the consumer's subconscious mind, including pricing the goods and services slightly lower than a whole number. For instance, in the retail store, let's say a commodity's price is $99 instead of $100. Although the price is slightly lower, for the consumer, it is in 2 digits and not 3. Therefore, it will be more attractive to consumers if $99 is charged for the given commodity, not $100. In psychological pricing, the most common strategy is charm pricing, where the sellers do not round up their prices. The consumer tends to believe that the prices are relatively lower as they process it from left to right, so that they may ignore the last few numbers of the selling price. Also, this strategy keeps the price within the defined pricing brackets, i.e., some points, 0.01 or 0.1, are less than the whole number. That makes the price more affordable in front of the consumers, attracting more customers. We one and get one free. Under this amount is paid for one product for which another product or service is given for free. This strategy has a psychological effect on the customer as the customer tends to make purchases to get an item for free. For example, the retailer adopted the strategy of buy one and get two free. Prestige pricing strategy. This strategy works mainly for the product that appeals to certain customers. For example, the use of this strategy by the luxury clothing brand to present the picture in mind of their customer about the excellent quality of the products. It is a practice of keeping prices higher than normal, as this strategy attracts customers who link higher prices with the superior quality of the products. Artificial time constraints. Under this strategy, there is a constraint on the time limit of sales. It will attract customers to buy the products within the time limit to avail the benefits of the sale. For example, offer stating one-day sale on selected products. Charm pricing. Shops may mainly use this strategy to attract customers by presenting lower prices. These prices are set so that they are just below the whole number. For example, instead of $9, the product is priced at $8.99. Price bands. If a customer has a predetermined budget or mindset regarding the purchase, fractional pricing of the product may sometimes come within their budget. It would be easier for them to decide. In this way, it would help in increasing sales. Control. It also acts as a control measure, as it would become tough for the cashier or other staff to calculate and steal cash out of the fractional amount. A barrier to competitors. It targets consumers who are more sensitive toward the product or service cost within any segment of a specific market. It helps eliminate cost control pressure and acts as a barrier in respect of competitive products shortly. Discount pricing. This pricing technique may be used for pricing a product in discount and mapping with a price ending with a specified digit so that it would be easier to identify the products with discount. Consistent demand level. Its effectiveness can be attained only when there is a constant demand for such a product or service within the market. If the price is reduced because of low demand, it may adversely impact customers as they wait for a further price reduction. Calculation. The pricing calculation may be a bit confusing for the cashier, and he might commit some unintentional errors which result in monetary loss to the organization. Dilute goodwill. The offer price displayed at the time of confirmation may differ from the final payable amount because of some shipping charges, taxes, etc. It might make the customer feel like they are being cheated, and they may create a wrong impression for the company. Psychological pricing, a subset of pricing strategies, comprises tactics commonly used to impact customer behavior. Research has shown that certain ways of formatting prices, opens in new tab, can spark a subconscious response from a customer and encourage a purchase. Because they are inexpensive and easy to implement, many businesses across industries use at least one psychological pricing tactic when creating or adjusting their pricing. As an added bonus, you can easily layer psychological pricing tactics over pricing strategies to boost the strategy's effectiveness and use them with both subscription and non-subscription offerings. Price anchoring recognizes that consumers tend to depend too heavily on an initial piece of information, the anchor, when decision-making. For instance, a jeweler might first present an engagement ring worth $18,000 as the price anchor. It then presents a ring worth $15,000, which to the customer seems much more reasonable and a good deal in comparison to the anchor. Thus, the customer is more likely to purchase the second ring than if they hadn't seen the anchor. Best for companies with a tiered pricing model that offers various versions and associated features of the core product, at different prices. Example, a company sells its A/B testing tool in 3 price tiers. Below, you can see the price anchoring strategy on full display. The first option listed, Deluxe, serves as the customer's initial piece of information, since most tend to look at the left-hand side of a graphic first. It's more than twice the price of the next option but only a little bit different in features, setting the stage for the next tier, Standard, to seem like a great deal. The price anchoring tactic can direct users to your preferred price tier and help them make the decision to buy your offering. To use price anchoring, you'll need an offering with multiple pricing options which customers can easily compare. Charm pricing refers to the use of prices ending in the number 9 because of the left-digit bias, a phenomenon in which consumers' perceptions and evaluations are disproportionately influenced by the leftmost digit of the product price. Research shows ending prices in 99, for example, $599, can result in more sales than rounding up to the nearest round price point, for example, $600. The human mind subconsciously rounds that $599 to $500, as opposed to $600, even though it's unreasonable. In a study noted in the book Priceless, opens in new tab, charm prices outsold rounded prices by 24%. Best for companies with non-luxury products that want to convey a deal. Example, a transcription software costs $9.99 a month. Due to that left-digit bias, many consumers think This product is significantly less than $10. It's a great deal. Advantage: with charm pricing, you can use the difference of 1 cent to majorly impact the user's perception of your offering's price. Requirements: to use charm pricing, your company must want to give the impression of a deal for its products. The tactic doesn't work well with luxury or recreational goods, which actually benefit from rounded prices. Odd-even pricing is similar to charm pricing but applied on a broader scale. This tactic leverages the belief that, psychologically, buyers are more sensitive to certain ending digits. Odd pricing refers to a price ending in 1, 3, 5, 7, 9, for example, $9.93. Even pricing refers to a price ending in a whole number or tenths, for example, $20 or $20.50. Odd pricing tends to be more popular because it indicates a deal in a customer's mind, making them more likely to buy. That doesn't mean even pricing doesn't have a place, though. Luxury brands tend to use even pricing to create perception of premium. Check out pricing on men's activewear at Old Navy. Opens in new tab versus Nike. Opens in new tab. Old Navy uses a mixture of odd and charm pricing, whereas Nike uses even pricing. Companies aren't limited to either odd or even pricing, though. For instance, Nike uses even pricing on all of its full-price products. However, its sales section, Opens in new tab, uses odd pricing to indicate the deal. Best for: even pricing works best for luxury items, while odd pricing tends to work best for most other products. Example: a wine subscription company offers 2 types of monthly boxes. For $29.43 a month, the standard box delivers 4 bottles of wine curated to your taste. For $60 a month, the same company will send 4 curated bottles that are considered premium. While $29.43 indicates a good deal and will likely attract customers who subconsciously round the price down, the $60 option embraces the expense to further the impression of luxury and exclusivity. Odd and even pricing can help create the perception of a deal and of luxury, respectively. There are no strict requirements, but companies should ensure their odd-even pricing use resonates with customers and creates the desired value perception of their product. The decoy pricing tactic is based on the decoy effect, by which individuals tend to have a specific change in preference between 2 options when also presented with a third option that is inferior in every way except one. The presence of the inferior third option makes the first 2 seem more attractive. Companies that have a preferred options to which they want to direct customers. For instance, decoy pricing has become more popular in the news media industry as companies try to move customers from print to digital. In his book Predictably Irrational, Opens a New Tab, author Dan Ariely notes that, at one time, The Economist had 3 magazine offerings. Web only for $59 a year. Print only for $125 a year. Web and print for $125 a year. It doesn't exactly take a savvy business person to recognize that print only is a terrible option, to the point it seems silly to include it. However, The Economist included this option because it caused consumers to view the web and print options much more favorably in comparison. Price bands. If a customer is accessing information about product prices that are segregated into bands, the use of fractional pricing can shift the price of a product into a lower price band, where customers may be more likely to make a purchase. For example, if a customer only wants to consider automobiles that cost less than $20,000, pricing a vehicle at $19,999 will drop it into the lower price band and potentially increase its sales. Non-rational pricing. If customers are swayed by the incremental price reductions advocated under psychological pricing, which is a debatable premise, then sales should increase. Control. It is much more difficult for an employee to create a fraudulent sales transaction and remove cash when product prices are set at fractional levels, since it is more difficult to calculate the amount of cash to steal. Conversely, it is easier to steal funds when prices are set at round dollar amounts. Discount pricing. If a company is having a sale on selected goods, it can alter the ending digits of product prices to identify them as being on sale. Thus, any product ending with a .98 price will receive a 20% discount at the checkout counter. Price calculation. It can be difficult for cashiers to calculate the total amount owed when fractional prices are used, as well as to make change for such purchases. This is less of a problem when credit cards and other types of electronic payments are used. Rational pricing. If customers are more rational than psychological pricing gives them credit for, then they will ignore fractional pricing and instead base their purchases on the value of the underlying products. Evaluation of psychological pricing. The overwhelming use of psychological pricing makes it clear that, whether or not the underlying concept is flawed, businesses are setting prices in this manner in order to compete with each other. Thus, to use the earlier example, setting a price a fraction higher than the prices charged by competitors might indeed lead to an incremental drop in unit sales volume, so a company probably has to use psychological pricing in order to remain competitive. Attention boost. Any type of big promotion will boost attention to your product. If you run a brick-and-mortar store, having big, red signs detailing your product promotion will obviously force people to look at what you're selling. If people don't purchase, at least your brand is gaining attention. Simplified decision-making process. Most psychological pricing tactics simplify the decision-making process for consumers. Having the discount or promotion laid out will give consumers less of an investment they have to think about. For retail stores that thrive off of one-time sales, this is a good thing. High return. Psychological pricing discounts can offer a high return on investments for one-time sales, especially during peak volume seasons, aka any holiday. With promotions that attract the masses, acquiring a high return at the end of the day is likely. Sense of urgency. Depending on the strategy you use, psychological pricing creates a sense of urgency. Customers will want to act fast so as not to miss out on the deal. This will also boost a quick high return on investments. Deceitful. Some people may see right through psychological pricing tactics and perceive it as taking advantage of customers. Some, however, may recognize the tactics and accept them as the essentials of doing business. Misperceived value. With psychological pricing tactics, there's always the risk of misperceived value. Your price is how you convey value to your customers. This type of communication hinges on your customers' perceptions of your pricing. If you lowball your prices just to trick your consumers into a quick deal, they may think lower of your product quality and expect those low prices continuously. Misperceived value. With psychological pricing tactics, there's always the risk of misperceived value. Your price is how you convey value to your customers. This type of communication hinges on your customers' perceptions of your pricing. If you lowball your prices just to trick your consumers into a quick deal, they may think lower of your product quality and expect those low prices continuously. Artificial time constraints. Buy one get one free. One day only. We've all seen this ad to some tune. Stores will place an artificial time constraint on a sale to create a sense of urgency. Stores employ time restrictions because they act as a catalyst for consumers to spend. The psychological tactic creates a sense of fear in consumers. If they don't act now, they risk missing out. The truth is, though, there will always be another sale. Charm pricing. This is the fancy and more official name for all the prices you see in-store that end with 9. Researchers at MIT and the University of Chicago found prices ending in 9 create increased customer demand for products. The science behind this is that people read from left to right. So, if they encounter a price at $1.99, they see the 1 first and perceive the price closer to $1. Charm pricing can have the opposite effect as well. Prices that end in 9 connote a value price, meaning you're getting a good deal. On the flip side, prices that end in 0 may connote a prestigious price and a higher quality product. If you want your product to be perceived higher value, charm pricing is a bad idea. Innumeracy. When offered buy one, get one 50% off versus 50% off of 2 items, most people select the first option even though both result in the same price. This scenario best describes innumeracy, a phenomenon in which customers are unable to recognize the fundamental math principles applied to everyday life. A study by Akshay Rao from the University of Minnesota School of Management found consumers are waning on discounts in favor of receiving something extra. We actually prefer receiving more items than a discount. Another psychological tactic nestled under innumeracy is double discounting, where the item will be marked down with an original percentage then an additional percentage off. For example, an item may be advertised as 25% off. Then, the company will offer an additional 20% off. Customers may perceive this as 45% off the item when really it's just 20% off of the discounted price. Price appearance. How a price looks to the naked eye impacts the psyche. Longer prices appear to be more expensive than shorter prices, even if they're the same number. The reasoning is that longer prices take longer to read, so people subconsciously couple time with cost. You've definitely seen this in a restaurant. Many restaurant menus will have the prices in smaller font and will omit zeros and dollar signs. Omitting the dollar sign makes the price look shorter and eliminates the direct association people have with the cash in their wallet. However, businesses must be careful not to take advantage of consumers through pricing or marketing tactics that may be considered unethical or exploitative. For example, misleading sales promotions or adding hidden fees can alienate customers and damage the brand's reputation. Customers expect transparency and honesty from businesses, and any deviation from this expectation can lead to lost trust and loyalty. When using psychological pricing strategies, businesses should also consider their long-term goals and sustainability. Short-term gains through manipulative pricing tactics may lead to significant revenue increases in the short term, but this may not be sustainable in the long run, and could ultimately damage the brand's reputation and customer loyalty. In summary, businesses should strive for transparency, honesty, and sustainability in their pricing strategies, while also leveraging psychological pricing tactics that align with their target audience's values and beliefs. By doing so, businesses can not only increase sales and revenue but also build strong, sustainable relationships with their customers. Customers are more likely to return to a business that prioritizes their needs and values, and this can lead to positive word-of-mouth referrals and expanded customer bases. Ultimately, ethical and effective pricing strategies can be a win-win for businesses and customers alike. Builds customer loyalty. When customers feel valued and respected, they are more likely to stay loyal to a business. This means they will return and continue to buy products or services, even if there are cheaper options available elsewhere. Positive word-of-mouth advertising. Satisfied customers are likely to recommend a business to their friends and family. By providing ethical and effective pricing strategies, businesses can create positive word-of-mouth advertising, leading to more people trying out their products or services. Sets the business apart. In a crowded market, businesses that prioritize their customers and showcase their ethical pricing strategies can stand out. This can help them differentiate themselves from competitors and attract more customers. Boosts reputation. When a company is known for its ethical practices, it can help build a positive reputation. This can lead to increased trust and respect from customers, which can lead to more sales in the long run. Contributes to a better society. When businesses prioritize ethics, it contributes to a better society overall. By avoiding unethical practices such as price gouging, businesses can help maintain fair competition and a level playing field for all businesses. This can also lead to a more positive and ethical business culture overall. When companies prioritize social responsibility and ethical practices, it sets a tone for employees to follow suit. Employees who witness the company's dedication to its social and moral responsibilities feel inspired to do the same. They become more engaged and more productive, knowing that their work is contributing to a greater good. Also, companies that invest in corporate social responsibility, CSR, and transparent business practices often attract highly talented and motivated individuals, who are drawn to companies that align with their values. In turn, this can lead to reduced employee turnover and a more cohesive and positive company culture. Ultimately, prioritizing social responsibility and ethical practices not only benefits society and the environment, but it also leads to a more successful and sustainable business. Furthermore, businesses that integrate CSR and ethical practices into their operations often enjoy stronger relationships with their customers and stakeholders. Consumers are increasingly conscious of the ethical and environmental impact of the products they purchase and the brands they support. They often prefer to buy from companies that share their values and are committed to sustainability. By prioritizing ethical practices and sustainability, companies can build stronger brand awareness, customer loyalty, and long-term profitability. Moreover, companies that prioritize social responsibility are more likely to be trusted by their stakeholders. Trust is essential for a company's success and longevity, and it can be achieved by demonstrating consistent commitment to ethical practices, transparency, and accountability. A trustworthy company is more likely to earn the support of investors, regulators, and other key stakeholders. In conclusion, prioritizing social responsibility and ethical practices is not only morally right but is also smart business. By doing so, Companies can attract and retain top talent, foster a positive company culture, enhance customer loyalty, and build a strong brand reputation. Ultimately, companies that prioritize CSR and ethical practices can create long-term value for all stakeholders and make a positive impact on the world. By incorporating these values, companies can contribute to sustainable development, and in turn, positively impact society and the planet. It is a win-win situation for all. Companies can enjoy financial returns and decrease risks while also making a positive impact on society and the environment. Therefore, it is crucial for companies to prioritize CSR and ethical practices in their operations, as it not only benefits their business but also contributes to the betterment of the world around them. CSR, or corporate social responsibility, is a vital aspect of modern business practices that prioritizes social, environmental, and economic sustainability. It involves companies taking accountability for their impact on society and the environment, by ensuring that their operations align with ethical and sustainable principles. CSR encompasses a range of activities, including reducing carbon emissions, supporting local communities, implementing environmentally friendly practices, and ensuring labor standards are met. By prioritizing CSR, companies can build a strong brand reputation and establish trust with their stakeholders, including customers, employees, investors, and regulators. It can also lead to increased productivity, reduced costs, and stronger relationships with suppliers and business partners. In addition, companies that prioritize CSR are more likely to attract and retain employees who align with their values and mission. Furthermore, CSR plays a critical role in mitigating business risks. For example, companies that prioritize sustainable practices are less likely to face legal and reputational risks associated with environmental pollution or labor exploitation. Additionally, companies that prioritize social responsibility are better equipped to manage crises, such as natural disasters or global pandemics, by responding quickly and effectively to the needs of their stakeholders. In conclusion, companies that prioritize CSR and ethical practices in their operations can benefit financially while also contributing to sustainable development. By taking accountability for their impact on society and the environment, companies can build a strong brand reputation, attract and retain employees, reduce costs, mitigate risks, and positively impact society and the planet. It is the responsibility of companies to prioritize CSR, as it not only benefits their business but also contributes to the betterment of the world around them. Thank you for watching the video and subscribe the channel.